Hey everyone, welcome back to the channel. Today we're talking about the impact of rising interest rates and just what that can mean for you. Wall Street Journal is letting us know we'll feel the rising rates as consumers. CNN is providing some insights for how we may be able to take advantage of rising rates. And The Economist believes this just may be the start of what is to become sharply increasing interest rates to fight inflation. To say this hasn't been a hot button issue in the last few weeks would be doing it a disservice. So why is everyone concerned about interest rates? And what does it actually mean? Well, the Fed controls the federal funds rate, which is the term used to refer to the interest rate set by the Federal Open Markets Committee. This is the target rate at which the Fed suggests commercial banks borrow and lend excess reserves to each other overnight. If you didn't follow that, no worries. It's saying banks will now have to pay more to borrow money from each other. This higher rate is then passed on to consumers from everything from credit card rates, mortgage rates, and even interest rates on savings accounts. This will actually be the first time the Fed has raised interest rates since 2018. If we look back at the last 20 years, the Fed tends to raise interest rates shortly before a large market fallout and recession. We see this in the early 2000s, 2007, and even 2018. The Fed raises rates to curb inflation that tends to occur after periods of prolonged low interest rate environments and too much economic expansion. So what do you need to know about raising interest rates this time? Well, the Fed has signaled they'll be raising rates to almost 2% this year, going from a rate of near zero. We haven't seen rates this high since before the pandemic back in 2018. The Fed ended up actually slashing rates to basically zero once the pandemic started. The Fed indicated though, this time they don't plan to raise rates above 3% anytime in the next few years. Normally, raising interest rates will restrain spending, which as an economy has been growing too quickly and inflation starts to run rampant. That's the goal. Now, how much the Fed will raise rates is still to be seen. A lot of it will depend on how consumers, investors, and businesses respond to the raising rates and if the necessary actions from the Fed have achieved the goals they hope for. So for you as an investor and a consumer, raising interest rates will have two main impacts. Historically, in times of raising rates, we start to see slower growth in the economy, and over the last 20 years, that has led to recessions. If we take a look at this chart from earlier, the bars in gray show when a recession happens. It almost always shortly after the rates hit their peak. Now rates are just now starting to go up. To use this as an indicator for a recession is definitely a bit premature. As we can see, rates increased from 2005 to 2008, and we didn't actually see a recession until the end of 2008. The same thing happened. We had slow rate increases from 2016 to 2018, and when the market started to get a little uncertain, we saw rates actually lowered before the recession brought on by COVID hit. Now, something to note here, just because we have a recession, that doesn't necessarily mean bad things for equities. Since 1920, we've seen 18 recessions denoted by the gray bars. This is overlaid on top of the performance of the S&P 500. What we can see from this graph is there tends to be a small dip during the recession, with a quick recovery, usually happening within 3 years of the recession. For investors, I'd argue if you're in a broad-based market portfolio, you don't really have anything to worry about. If your outlook is longer than 5 years, you're going to be just fine. Just make sure you aren't selling at the bottom just to buy again at the top. Now, the second major impact that raising rates will impact for consumers is house prices. Historically, what we've seen is for every 1% increase in mortgage rates, an individual's purchase power will actually decrease between 9 to 10%. The reason for this is as a buyer, you're qualified for a principal and interest monthly payment. So for example, if you're approved for a $1,200 payment per month and rates are currently 4.5% and you're putting 20% down, you qualify for a mortgage of roughly $240,000, and then you would bring a $60,000 down payment, putting you in the market for a home right around $300,000. Now, if interest rates increase just 1% and you want to keep that same principal and interest payment of $1,200, you can only take out a mortgage for $216,000. That's roughly $25,000 less that you can afford in the higher rate environment. That $25,000 represents roughly a 10% decrease in your purchasing power. And now you can only afford to buy a home for $275,000 if you still bring that same $60,000 down payment. Now let's take this one step further. If everyone's purchasing power is decreasing 10%, we would expect to see a very similar trend to the prices of houses as well. Similar to the S&P, we can look at median home prices by year in the US. What we will see is the gray bars are the areas where recessions have occurred, and we know right before those times we saw increasing interest rates based off our prior graph. We can see there's usually a pullback during the time of a recession for house prices. As well, which could correlate to those raising rates. However, just like we saw with the S&P, after a few years, we tend to see a recovery in housing prices, although it does appear to be a bit slower than what we've seen happen in the stock market. With looking at the information, I think this time it might be a bit different though. Something we haven't seen historically, but we're seeing right now, is there's a lot of all cash offers, something that really we haven't seen in the past. We're also seeing about 30% of homes in the fourth quarter of 2021 was actually purchased by investors. And we're also seeing kind of this great migration, and individuals who have sold in a high cost of living area only to relocate to cheaper areas, and bringing large equity checks and putting down significantly more than 20%. So I think in this case, interest rates may not have the same impact we've seen historically for buyers. With a lot of buyers coming down with more cash and moving to cheaper areas, they can actually afford more home. So I think this time we may not see the same broad-based decline in housing prices for areas that have historically had lower cost of living areas due to the influx of individuals. But areas that have already seen mass exoduses of individuals may end up being impacted harder. So think areas like San Francisco, New York City, where a lot of tech workers are actually actively trying to leave. Interest rates may have a bigger impact on those areas for the individuals staying behind. Though, as a consumer, raising rates, they may sound scary, but this isn't the first time, and this surely isn't the last. Even if a recession does happen, history has told us that the market will figure itself out shortly after. As long as you don't panic, and you don't sell at the bottom, let this ride out and ride the waves that get thrown your way, and I think you should be fine. As always, thanks for tuning in, and if you haven't, please like and subscribe.